turn it on.
If you want something nice and cold to drink, you can pick up your own. You've been in Denver now for a year or so. What do you think?
Yeah, it's actually volunteer.
All right. Hello, everybody. Thanks for joining us today at the University Club. My name is Ben Truitt. I'm the program chair for the CFA Colorado. And today we have an excellent program planned. Andrew Patterson is joining us. He is a CFA charter holder and a senior investment strategist in Vanguard Investment Strategy Group, where he leads the team charged with developing and communicating Vanguard's economic and market outlook. He has co-authored research on a number of topics, including the global economy, fixed income, and asset allocation, while also providing support for various investment management initiatives, including the Vanguard Capital Markets Model. Today, Andrew will be speaking to us about growth and inflation concerns at home and abroad. How do we tune out the noise and focus on the trends that are truly important? And can we position ourselves for investment success? Please join me in welcoming Andrew Patterson.
Thank you, Ben. Thank you all for the opportunity. As I mentioned, I'm a member of our investment strategy group. We spend quite a bit of time buried in models and spreadsheets, so it's always a pleasure to get to pick your head up every now and then and come out and speak with clients. And it's always a special pleasure to speak with individuals such as yourself who have shown the commitment and dedication necessary to get through a very rigorous and highly regarded program and exhibit those qualifications going forward, such as the CFA Charter. So again, thank you for your time. So today, I'm here to talk about Vanguard's economic and capital markets outlook. I'd like to keep this light, discussion-oriented if possible. I do have slides, do have prepared remarks, so I'm happy to go through slide by slide, but my wife tells me that I have a tendency to drone on sometimes. So please do interrupt me with any questions that might be front of mind, whether it's on the slide in front of you or anything like Japan, news coming out of there. We just had a Fed announcement. And for those of you who may not have it as a pop-up on your phone, the Fed actually did not raise rates, so they're maintaining the quarter to 50 basis point rate. But a couple of interesting things in the information release. One is that they shaved off around 50 basis points each year in 2017 and 2018 in terms of how high they think the rate is going to go in those respective years. So a slower path to an ultimate terminal rate. And there were also 3 dissenters this time around. One of those including Eric Rosengren, who had traditionally been viewed as very dovish. So, and again, on top of that, they actually included in the statement, and I'll read this verbatim, I didn't have time to memorize it. The committee judges that the case for an increase in federal funds rate has strengthened, but decided for the time being to wait for further evidence of continued progress towards its objectives. So I think that's pretty forceful language. I have a feeling the market's going to interpret that as hawkish in the near term. So again, as Ben said, my intent here is really to go through some of our views and try to help your clients tune out some of that noise. Right? Some of that noise tends to be what I just talked about, unfortunately, is Fed policy, right? Concerns around global issues, around Brexit. Right? There's always going to be a Fed decision. There's always going to be a referendum or the next slowdown in China. So it's really helping your clients to maintain that focus that's necessary to achieve their investment goals. So hopefully we'll get through that in our allotted time. So what we have here is we've taken our economic and market outlook, right? It's an annual publication. It's usually around 40 pages. There's, give or take 30. There's 6 authors on it, but that really doesn't do it justice, right? It represents the views of the entire investment strategy group, 60 of us worldwide, 12 of us in Malvern, Pennsylvania, outside Philadelphia, Hong Kong, London, Australia, among them PhDs, MBAs, CFAs, CPAs, all with varying views on where we're headed as a global economy, where we're headed in terms of financial market returns. So that's all synthesized down into our economic outlook, and what I've tried to do is take this and distill it even further down to the 3 key points. Right? Again, if you have questions around anything around these points or anything else from mine, please do let me know. In terms of growth, right, we believe, and have for some time, that rather than being stuck in a secular stagnation environment, as is being voiced by the likes of Larry Summers, Paul Krugman, et cetera, where it's a low growth, low demand environment that we're stuck in that has to be broken through by policy, by fiscal policy. Right? We believe rather it's more of a structural convergence wherein underlying factors that drive growth, whether it be demographics, productivity, what have you, those are not contributing in the same ways they have in the past. Right? Not to say that we're in for a period of episodic recessions, but rather that we should get comfortable with the idea that we're not going back to pre-recession levels of growth. Gone are the days of 3.5%, 4% growth in the U.S. and abroad. Even if Mr. Trump builds his wall, I don't think that's going to be enough to get us out of the low growth environment. Right? So again, it's something that we want to be very upfront with our clients to help them to try to understand that this is something to be acknowledged, if not embraced, rather than feared. So we think it's very, very important to be upfront about the growth environment going forward. On the inflation front, we've got a lot of questions over the years, maybe less so now, about where is inflation? Right? Shouldn't inflation be right around the corner? Right? The Federal Reserve and global central banks have huge balance sheets. Right? $4.5 trillion in assets held at the Federal Reserve. That's a lot of liquidity to push in the marketplace. Okay? How could that not be inflation? In normal times, absolutely, 100%. That's inflation. You're getting inflation 4.5% at the low end, likely. Okay? But we don't live in normal times. Okay? We haven't lived in normal times for some time, since the global financial crisis, right? So it has taken extreme measures such as that, such as $4.5 trillion in the Fed's balance sheet, continued low, and in the cases of Europe and Japan, negative interest rates, just to maintain the degrees of inflation that we're experiencing today, which are low by historic standards. We don't think that's going to change anytime soon either. Inflation is not our biggest fear. More so, we'd be concerned with lack of inflation, or even in extreme cases, deflation. So in terms of where prices might be headed, we believe we have a good foothold here in the U.S. Unfortunately, can't really say the same for our developed market patriots in Europe. Then that brings me to policy. Where is policy headed? Monetary policy, for the most part, has been carrying the load for the better part of the last 9 years. At some point, that does need to change. There needs to be a pivot. I think we're getting close to that. I believe that's exemplified in the statement that I just read. That's also exemplified in the actions of the Bank of Japan earlier today, where they decided to expand their quantitative easing policies. So monetary policy is starting to reach its limits. Negative interest rates symptomatic of that. Not a last-ditch effort, but that seemed like the logical step for Europe and Japan. But we don't believe that it's having the desired effects. So likely to see policy changes coming in the near term. So then the next question is, what does all this mean? Right? What does this mean for our investors? Again, I could spend all day buried in models and spreadsheets and algorithms, but at the end of the day, what clients really want to hear about is, what does this mean for my portfolio? Right? What does this mean for returns? Well, unfortunately, the outlook for that isn't necessarily as bright as some might hope for. That said, we think it's very, very important to be upfront about that with our clients, what our return expectations are. In our case, again, given our views on growth, low inflation, policy and policy ineffectiveness, we would expect on the fixed income side, fixed income returns somewhere in the 1.5% to 3% range for the foreseeable future over the next 10 years. I'll get into Vanguard's approach to forecasting later on, but suffice it to say, it's going to be, in all likelihood, a low rate, low return environment in fixed income portfolios for some time. Then that translates itself over to equity portfolios as well. So what do we see on the equity side? Again, less than historic average on equity, somewhere in the 10-11% range. We would view equity returns in all likelihood, again, over the next 10 years on an annualized basis, somewhere in the 6 to 8% range. Right? It's a difficult pill for a lot of clients to swallow. Right? Gone are the days of 8-9% returns on your 60-40 balanced portfolio, it'd be a much tougher environment for returns. So much tougher environment for a lot of client conversations for those individuals who may not be able to or willing to accept these types of returns. But we think it's important to have that conversation. Any questions about that or any of our views or anything else before we go into some of the work we did provide with you?
Your 8% seems kind of high for your equity side. Give us some detail around that.
So in terms of equities, 6 to 8% at the median. Again, we tend to approach forecasting in a distributional nature. I'll show that slide later, where fat tail events, rather, or extreme events, rather, are actually much more likely than they were in the past. In all likelihood, volatility is probably going to be front-loaded in that 6 to 8% return range. So we've got some issues to work through with equities. So not calling for 6 to 8% returns year in, year out, but more so over the long period of time as the ebbs and flows even themselves out. That's in comparison to what had been since 1920s, around a 10% return on the equity portfolio. We're not necessarily calling for a bear market. What we look at, what we tend to look at in terms of equities is more on the valuation side. Well, valuations, when you account for level of interest rates, inflation, maybe a little bit closer to what you might expect, as opposed to some investors who think that they're rather high by historical standards.
Can you provide some color on domestic versus international, developed international?
Sure. So let me just jump into the slides here. So I mentioned before what we tend to look at in forming our equity views, valuations. Right? Tend to be a good measure. It's not a perfect crystal ball, right? but it helps make our crystal ball a little bit spot. Right? So I mentioned investors who sometimes refer to the historic average and say, well, at 20 times earnings or 19 times earnings today, depending on the metric you're looking at, valuations seem high by historic standards. If you look at historic standards and just take an average over time and consider that a mean reverting target, what you're essentially doing is saying that I believe that financial and economic markets have not fundamentally changed over whatever time period you're looking at the average. So in this instance here, we're going back to 1950. If you tell me that there's been no fundamental changes in the operations of economic and financial markets since 1950, I find that hard to believe. So what we've done is we tried to account for some of those changes by incorporating things such as interest rates, inflation, and inflation expectations to try to provide a gauge of what type of environment we're operating in. Right? I mentioned earlier about the low interest rate environment, low inflation environment likely going forward. So when you account for those, the tan line on the screen is the cyclically adjusted price-to-earnings ratio. Robert Shiller's preferred measure there. It is pretty standard for the industry. What you're looking at there is the average of the last 10 years of earnings twice over the last 10 years of earnings. What we've done is we've incorporated into our model, in addition to those earnings, also inflation expectations. So when you account for that, it actually brings you back to that black line there. And again, we talked about the distributional nature of the forecast, so you put some airplanes in around that. And you can see that those ebbs and flows, they don't necessarily, or the ebbs and flows rather than the tan line, don't necessarily correlate with that green line, but more so they follow that fundamentally adjusted black line. Right? And if you look at it today, valuations aren't really that far removed, actually maybe a little cheap. Right? I struggle to tell that to clients in the current environment, but they don't look that far removed from where fundamentals might suggest. So that's one of the reasons why we're not as fearful of an impending equity market correction as others might be. So translate that into our views internationally. Right? You can see here on the right-hand side, the dark blue line, those are valuations for the U.S. The tan line is valuations for developed market non-U.S. equities, and then emerging market equities in the light blue line at the bottom. You can see a pretty wide disconnect, or discount rather, between the U.S. and developed market fundamentals, even more so with emerging markets. Again, this isn't a call for an emerging market play because these discounts that we're trading at aren't necessarily without justification. Right? Emerging markets remain a very, very risky asset class. So we tend to advise investors to tread lightly when you look at this as the end-all be-all of equity market projections. So we take that, incorporate it into our modeling, and then, again, keeping with the distributional nature of our forecast we talked about, we look a little bit deeper into sub-asset classes. Right? Outside of just the 6 to 8% on global equities going forward, we dissected into U.S. equities, global equities, ex-U.S., and then also emerging markets actually is not on this, but we do look at those as well. And you can see the distribution, box and whisker plot, 75th, 25th is the box, and then the whiskers there, the 5th and 95th percentile of our return projections. You can see that it's somewhat tilted to higher for global equities ex-US than it is for the US itself. So US itself somewhere in the 5 to 7 range, global somewhere in the 6 to 9% range. So again, this isn't a call for a global overweight, but just an acknowledgement of current conditions. And let me just say that, again, this is annualized 10 years. Right? So there's quite a bit of risk that goes into any one of these forecasts. Right? So if you try to interpolate that back into a one-year distribution, your box and whiskers are not going to be that narrow. There's going to be a much wider distribution, even more so on the international side than on the domestic side. So let me walk you through a little bit about what we do and our approach to forecasting and how we come to use it, we should. So we talked about before a slowdown in growth, right? That doesn't just mean developed market growth. It doesn't just mean the U.S. In all likelihood, we're going to see slowdown in growth across the globe, right? Including emerging markets. Right? A lot of that due to slowdown in China. Right? When I talked about some of those underlying fundamentals, the aging population, that is not just an issue we face here in the U.S. It's actually much more of an issue in Europe and Japan. And it's even becoming an issue in emerging markets, China chief among those. So that's going to tend to temper growth going forward. Another thing that's likely to temper growth is lack of demand for debt. I'm not saying that that's necessarily a bad thing. But we believe that less levered debt going forward is likely to be, or less levered growth going forward is likely to be more sustainable growth. And so we welcome that. But we do need to acknowledge to ourselves and with clients that we're not going back to those historic levels of growth, right? We're not going back to, China's not going back to 10, 12%. We wouldn't expect it to. We wouldn't want them to. That would mean they were still stuck in what's termed the Goldilocks era for growth in emerging markets. What do we mean by that? Well, with the emerging market, you have an opportunity for significant technological build-out. So if you look at sub-Saharan Africa, they can import iPhones and immediately be brought to speed and be more productive. Right? The ability of emerging markets to do that and to build out infrastructure, you can only build so many roads before you start building roads to nowhere, and we know that those aren't efficient. That's starting to wane in emerging markets. They're becoming much more developed in nature. So that also is going to wane our growth going forward for them. So we would expect the gap between developed and emerging markets to continue closing over the next several years. So, what does that mean for the U.S.? This is one of my favorite slides. And I think it's very, very important. And I don't know that it's getting the discussion that it deserves, that it warrants. I'm going to listen to Janet Yellen's press conference this evening, and we'll see if she brought it up. But it was not brought up in a statement, and it has not been brought up in Fed communications since last fall. They're talking about it a bit. Essentially, what does this slowdown in growth mean for the labor market? Should we continue to expect 200,000 jobs per month? That's a lot of jobs, right? Over the last 2 years or so, we averaged around 200,000 plus jobs a month. That's closing in on 5 million jobs added over that time. That's a lot of jobs to add to an economy. Can we continue at that rate, especially given our low growth forecast, given some of those demographic headwinds I talked about, given some of those labor market participation has been coming down recently? We don't think so. Right? We think much more indicative of the norm going forward would be labor market numbers somewhere in the 125 to 150 range. Right? We had a bit of a scare back in late spring, right? With some numbers coming in a little bit under expectations. That evened off over the summer, and then we got our 150,000 print in August, which missed low in terms of expectations. One positive thing away from that actually is that markets didn't react too negatively to it. So it seems that to some degree they may be anticipating this, but we think it would be important for the Fed to start coming forward and explaining that while the labor market will continue to strengthen, it's not likely to do so at the pace it has in the past. Right? So if the market is caught off guard with 100,000 or less jobs in a given print, it doesn't react too negatively. Any questions about that?
What's the normal growth rate of the economy? How many new people are coming into the jobs market out there?
So historically, and when I say historically, we're going back to the 1970s, right? Certainly as the population grows, you're going to have more of a population, so you have a larger level. Historically, there have been around 150,000 new jobs a month to replace, or actually to just keep up with the pace of people entering the workforce. That's since fallen. I've seen measures calling for 125,000. I've seen measures 100,000 below. Some measures as low as 80. So with these 200,000 plus jobs a month, we continue chipping away at the unemployment rate. At some point, that becomes inflationary. Right? And I think that's one of the concerns of the Fed. I think that's why, even if you do start to see a slowdown in employment numbers, that's not necessarily going to knock the Fed off their intended goal of raising rates. Sure.
What do you see happening with labor force participation and whether there will be a bounce back from the low levels recorded during the crisis?
It's a good question. So we did see a bit of a bounce back midway through the year. We saw the labor force participation rate bounce back up to 63%. And actually last fall it came up as well a little bit. We think that was, unfortunately, that may have been the cyclical rebound Janet Yellen's been holding out for, waiting to see a labor force participation rate increase, because I mentioned those demographic forces. They're very, very powerful forces. Very, very easy to predict. You can see it coming, but if you don't acknowledge it, it can be caught off guard. So what's happening with labor force participation is symptomatic of an aging workforce. We've heard a lot of anecdotal stories of individuals working longer, working later in retirement years. And that's great. Going on board, productivity tends to benefit from that. Productivity of older workers tends to be higher than that of younger workers. They're better trained, right? They're able to train those younger workers to be more productive themselves. So anytime you see older workers leaving the workforce, so we've seen workers holding on longer to retirement years and sticking around. We think that's a positive thing. That said, you've seen a doubling in the labor force participation rate for individuals age 65 and above since 1990. Doubling. That said, it's going from 10% participation rate to around 20. Okay? Compare that to individuals under age 65, from 55 to 65. That's been increasing as well, but that's increased from 45 to 55%. Okay? Compare that with individuals in the 45 to 50 cohort, or individuals in the 25 to 35 cohort. That's closer to 75 to 80%. So as we continue aging as a society, you're unlikely to see a significant bounce back in the labor force participation rate. You just don't see it being in the cards. So that is likely to serve as a detractor on growth going forward. In the near term, it's more likely that you're going to see that reflected in the employment numbers.
What kind of employment growth are you forecasting domestically versus developed markets, I guess, versus emerging markets? What underlies your forecast?
So where are we coming with these views, the bars? Sure, so from a developed market standpoint, the US is really leading that bounce back. Okay, we're bouncing back from average growth rates from 2000 to 2015, which were pretty tepid. Right? So we think that there's a little bit of room for growth rates to pick up, both here in the US, right? We would expect growth in the 2–2.5% range, and in Europe. They have some issues to work through clearly. Right? They should get on track at some point. You could expect growth there of around 2% going forward. From an emerging market standpoint, as these economies aren't able to take advantage of that low-hanging fruit, they're not able to just continue building out their infrastructure. They actually have to start depending more and more on consumption. Right? That tends to be a drag on growth. I hesitate to use that word because it's actually a positive thing. When your economy depends more on consumption, it means that you're becoming a wealthier nation. Right? But it has historically been a drag on growth, and that's one of the reasons why we have the views we do representing the tan bars there. I think China, as I mentioned before, exemplifies that. So what we're looking at here on the right-hand side are growth rates, not only in China, in the red diamonds there, but also a lot of their similar Asian market trading partners. So what we have along the x-axis, that's a measure of GDP per capita. It's a measure of wealth, right? As you move out that x-axis, you're becoming a wealthier nation. You're becoming closer and closer to developed market countries. Right? A lot of their Asian trading partners, Taiwan, South Korea, Hong Kong is technically a trading partner. Singapore, they've made the jump in many cases into developed market territory. Right? But as they've done that, they've also experienced a slowdown in growth. Okay? What we have in the box and whiskers there, the blue, is the experience of those trading partners, the distribution of that over time as they've moved along that x-axis. You can see a slowdown in growth along the y-axis. That's already happened. That was their experience. China's going through the same issues right now. And again, not to say that those are issues, it's just more matter of fact. That is the state of things when we're becoming a developed market economy. So that plays a big role in our views on slowing growth in emerging markets. And then because so many emerging markets are dependent on China for trade and their own growth, that tends to solidify our view that emerging market growth going forward isn't likely to rebound to historic levels.
Are you seeing any mismatch, slowdown in growth based on sort of mismatch between what the economy needs in terms of jobs and those who are prepared to step into those jobs or unable to step into those jobs?
Evidence of that is a little bit more anecdotal. I will say one thing. So if you look at the JOLTS report, it's another type of employment survey. If you look at that, there's 5 million unfilled positions out there. If you were to fill all those, and this is a big stretch, but if you were to fill all those, our unemployment rate would be 1%, right? So clearly there's a mismatch between what employers are looking for and the skills that individuals have. It's not that great that all those jobs should be filled because there has to be unemployment in some way due to labor market frictions, people don't want to move, et cetera. But there certainly is somewhat of a skills mismatch. I think going forward, absent any sort of we can't depend solely on government policy for this, but it's on educators as well to make sure that they're working with businesses to make sure that they're training people in a way that it's going to be applicable in the new economy.
You think JOLTS is an underestimated number largely because it doesn't include discouraged workers and things of that sort, which don't even show up in those types of things?
So I think that if you look at the U6, which does include discouraged workers, that's starting to come back down. The unemployment rate, the U6 unemployment rate includes discouraged workers, as you mentioned. That's coming back closer to historic norms. It's still a little bit high, but it has been trending down. Whereas the U3, which does not include discouraged workers, that is at or near at 4.9%, 4.8%. Very, very close to what the Fed released today is their view of the natural rate of unemployment. That rate that, given all those frictions we talked about, we expect unemployment to be around that range.
What's the U6 at right now?
U6, I think it's a little bit north of 10%, I believe. Again, that's going to include discouraged workers. It's going to include individuals who have looked for work in the last 12 months, but maybe not in the last 4 weeks. It has been trending down, but it is still certainly a concern. And I think one of the reasons why the Fed is hesitant to raise rates and really call the labor market at full employment.
I just kind of wanted to bring this back to investing.
Sure. Please.
I think you made a great case for a slowing worldwide economic activity. That translates to me that if we're going to be looking at slower growth, if I'm looking at investments for my clients, dividends very likely could play a much larger part within the total return of the portfolios. And we, is that something Vanguard is taking a stance on at this point in time, or what's the feeling today?
So they can play a role, right? So I'll reference this in trying to answer your question. This is, again, distribution nature of our forecast. I touched on this earlier. What this represents is it's the output of our capital markets model. Right? Our capital markets model, it's a quantitative tool, 10,000 different scenarios. So we get asked all the time, well, does this include a scenario where interest rates are high, dividend rates are low, and inflation is long-term average? Yes, it does. Does it include an environment where interest rates are low, dividend yields are low, and inflation is very high by historic average? Yes, right? So this includes a subset of all those different scenarios, and you bucket them down into different cohorts into their return annualized over the next 10 years. And you can see, given the distribution here, central tendency I talked about earlier, somewhere in the 6 to 8 range, okay? But those tails certainly not out of the realm of possibility, right? Those risks there, you can see them in the blue, somewhat elevated relative to what they were back in 2010. Right? In 2010, you're looking at tan lines, same model run, current year, 10-year outlook. You can see it shifted somewhat to the left. So concern among us within the investment strategy group about rising risk to equity markets. Right? I'm not trying to circumvent your question, but
I think I understand where you're going.
where we're going in terms of individuals who may be looking for additional income. Okay? If that's the role that bonds are playing in your portfolio, that's a deeper discussion between yourself and your client. If however, bonds are viewed in a diversification role, bonds still maintain that diversification abilities. Right? So if you start moving out into things such as dividend-paying stocks, so what we're looking at here is the bottom decile of equity returns over the last 27 years, give or take. Those given months, so on average it was around a little bit north of 6% loss for those worst 10% of months. And then we looked at other asset classes and how they performed in that given month. Right? You can see that traditional diversifiers such as bonds, investment grade bonds for that matter, tended to perform best. Right? Don't completely offset the loss, but it's tempering a bit. Right? When you start moving into other types of, we'll call it alternative fixed income, whether it's higher yielding bonds, emerging market debt, dividend paying stocks, those tend to have a bit more equity-like features in them, in their return stream, so you don't get the same type of offsetting effect. If you're looking at this in a total return basis, rather than simply an income stream, it tends to change the conversation a bit. Right? Clients who, if their main goal is income, that's one conversation. If their goal is maintaining a specific value in your portfolio, that's another. Right? So if you start looking at a total return basis, you start to minimize your diversification benefit and start moving into dividend-paying stocks and such. Any questions? Sure.
Well, given all that, when you talk about the low rate environment, where do you recommend that income client that go for that income stream they're so used to?
Unfortunately, I believe it's a difficult conversation and acknowledgement that they may not be getting that income stream they have become used to. Right? Our views on yields over the next, fixed income returns over the next 10 years or so, including income, very tempered relative to history. It's due to a large degree to where yields are. We don't necessarily see yields picking up anytime soon. Okay? Not saying that it can't be wrong, right? I know that there's some very prestigious pontificators out there calling a bottom in the bond market, but one of those who used to head a very prestigious investment firm out in Newport, California, now has a new job because of his yields rather than reach the bottom. So we tend to take a step back in calling for the imminent rise of rates. So our views on yields over the longer term, again, looking out 10 years, tend to be tempered. Right? We think fair value for the 10-year could be around 2% today, give or take. So a little bit above where we are, but not too far. Given that expectation for continued low growth, continued moderate inflation, right? Pegs our yield forecast, and we end up with a fixed income outlook, again, compared to 2010, which is even moderated since then. You look at that, to your point, compared with clients' expectations that may have been set during the 80s, 90s, and even 2000s bond bull market with 7, 8, 9% return in bond investing, we don't think we're going back there. So if they really are dependent on that income and can't make spending decisions, or they can't make savings decisions that would temper that change, it may be time to start talking to them about their willingness to move out the risk return spectrum.
Do you guys have an outlook in terms of the shape of the yield curve?
In terms of where it will end up,
Will it continue to flatten as it has been? Will it continue to kind of return to its normalization?
so yield curve, when I last looked, I haven't seen what the response has been since the Fed statement. The slope of the yield curve, 10-year minus 3-month, was about 120 basis points last I checked. Historically, that's around 150, so it is low. We're seeing that type of compression across developed markets as well. And that is somewhat concerning. I think it's somewhat concerning for banks, for pensions, right? So I would expect in all likelihood, particularly here in the US, you're gonna start to see a bit more of a steepening, right? Especially given the foothold we have with inflation expectations. That tends to drive more so the longer end of the curve. Again, not calling for a taper tantrum like 100 basis point swing in yields out of the 10-year frame, but we would expect somewhat of a steepening in the near term, even as the Fed is raising the shorter end, because the Fed acknowledging that the economy is able to withstand rise to the short end is an acknowledgement that conditions are relatively good, right? So if conditions are relatively good, you have greater expectations for growth, again, albeit moderate. That tends to drive interest rates out the long end, in addition to those hopefully increasing inflation expectations as well. So short answer, yes, we would imagine that the yield curve would steepen over the medium term, back to more historical levels.
You want to throw a number, like a 10-year and 30-year, just so to quantify what you're saying?
So, yeah, so the 10-year, we could see, again, a fair value of around 2% right now. And given where the Fed funds rate is today, 25 to 50 basis points, so you're at 150 basis points there. As the Fed continues to increase interest rates, not saying all that's going to get translated out the longer end, but if they were to progress, so I was in a meeting today where I talked about my hesitancy to refer to this current tightening cycle as tightening, and one of the advisors we were speaking with actually, I'm going to steal, not borrow, his terminology for it. He called it, rather than tightening, it's a GREEP. It's a gradual removal of extraordinarily easy policy, okay? $4.5 trillion balance sheet, that remains very, very easy by historic standards, okay? The fact that the policy rate is where it is, so far below what is likely to be its new longer-term normal of around 2.5, 3, still very, very easy, right? So going forward, we would expect them to continue raising at a moderate pace, remaining their favorite terminology, data dependent, such that you could see the policy rate creeping up to maybe 1% or so, give or take, over the next 12 to 18 months. And then that gives us a 10-year treasury, assuming that slopes maintain, 10-year treasury of around 2.25, 2.5, give or take, over time, over a long period of time. We're not calling for a taper tantrum-like issue where you see 100 basis points up across the spectrum.
Is that due, do you consider that due to the fact of the spread in yields between foreign bond markets and the U.S. bond market where, you know, I mean, I'd rather buy a 10-year treasury at 2% than a 10-year bond at 0.
I can always count on you to bring me back to the presentation of my slides, so thank you very much. So what we have here, there's been quite a bit of talk, and we're guilty of this as well. Right? One of the themes of our outlook last year was divergence in monetary policy. So here in the U.S., I mentioned we're in a bit stronger foothold than some of our developed market brethren. So ripe for rate increases, gradual rate, GREEP, again, GREEP. That said, given the environment internationally, you have negative rates in Europe and Japan. Japan has expanded their policy options as well again this morning. Likely to see that continue to evolve over time. But we would struggle to see an environment where the U.S. can get much beyond where international markets are from a fixed income standpoint. Right? You mentioned the reach for yield, and I can't believe I'm saying there's a reach for yield when treasuries are at 170 basis points, but that is the environment that we live in. So you have international investors depressing rates to some extent. So we would actually signal this is really more of a convergence than a divergence. You can see in the graph historic policy rates over time. The gap between those, on average, 250, 300 basis points. We saw that going back to the 80s, give or take. That's not here today, right? We're at about 100 basis points today, if that. Maybe the Fed can get 100 basis point spread, that is, between policy rates in Europe and Japan and the US. Maybe the Fed can get to a 100 basis point policy rate, but they're going to struggle to get much beyond that for an extended period, absent any sort of change in international conditions. And they've acknowledged this. They've acknowledged international conditions being something that's kept them on hold in the past.
Can you expand a little on this debate about whether the Fed is really out of bullets or not, or central banks broadly if they're out of bullets or not? I hear this a lot, but I think also a lot of people have not, didn't anticipate some of the things that have occurred from the central banks, like quantitative easing and negative interest rates. So how do we know that banks don't have more cards up their sleeve that are just non-traditional?
So I think they're always going to have the quantitative easing card. They can always buy more assets, right? They print money. It's another word I don't like to use because technically it's an electronic transfer or what have you. They're not printing money, it's the finance ministers and the treasury. But they have that option, right? They have that option to expand their balance sheet. I think they're coming to a point now, and the Bank of Japan actions this morning, and the movement of negative interest rates before that were an acknowledgement that monetary policy is starting to reach its limits. I don't want to say that they're out of bullets. The bank will never say that they're out of bullets, right? But they're starting to reach their limits. Right? At some point, some of the weight of this has to start being carried by other types of policy. Fiscal policy isn't necessarily the end-all, be-all solution, right? Both candidates have infrastructure spending on their platforms. Not saying that's going to be a long-term solution because it won't. Right? What we have to do is acknowledge the slow growth environment, the environment that we're in, and look for more structural reforms. Labor market reforms, education reform. Those aren't being really talked about as much today, maybe a little bit in Japan because they're acknowledging that Abenomics and the three arrows, they haven't really addressed that third arrow of structural reform. So I think it's important that policymakers come together and really start talking about that in a serious way because monetary policy is starting to reach its limit. We can see here on the left-hand side, and that's actually demand for debt coming from households and businesses. You can see in the darker portion there, that's where we stand today compared to pre-crisis averages in the dotted lines, far below those. Okay? Public and private investment on the right-hand side, that has lagged relative to pre-crisis standards. Those are two very, very important transmission mechanisms for monetary policy. When those are impacted and those are fractured in the way that they are today, it's very, very difficult to see monetary policy having the effect that it may have in the past, and especially given the current state of financial markets today, being able to do that going forward. So they're acknowledging this. Janet Yellen has said it, and Bernanke before her, Mario Draghi has echoed that. Monetary policy has limits. At some point, it's going to be on policymakers on the fiscal front, structural policies, those are going to have to start playing more of a role.
When you buy negative yielding debt, such, I think, what Switzerland is negative 49 basis points on their
A lot, yeah.
10 years, something like that. Don't you have to put that as a liability on your balance sheet? Because you're going to get paid less than what you're...
For the banks, the central banks are the only institutions I can think of right now that do not have to operate with a profit. They don't have to turn a profit. Any profit that they make gets handed back over to their respective treasuries and ministers of finance. So they do not have to turn a profit. They can turn a loss and still operate. So in terms of ledger accounting, that may be the case, but they're not worried about it.
So they would be the only ones that could be buying Swiss debt right now, is what you're saying?
Central banks? I think there's...
I mean, because if a company buys it, I mean, that's... Do you understand what I'm saying? I mean, it's not a guaranteed loss. You're just mitigating or kind of monetizing the loss to a certain extent, unless you think somebody's going to buy it at a higher price.
Exactly. So you have that consideration. Japanese debt has been very, very low, if not negative for some time, and you see a huge uptake, whether it's patriotism or they just want the safety of relative safety in their view of fixed income. They've been more than willing to purchase significant amounts of government debt at very low, even in this case, negative rates. We're lucky, and again, you've brought me back to one of my slides. One of those reasons that we've been talking quite a bit about is the fact that our U.S. investors do not have to worry about that, right? So you do not have to worry about, if you're talking to your investors about international bonds and negative yields, because we're not in a negative yield environment here, we don't have to worry about that, right? Whether it's it's because of the return on hedging, or it's the eventual currency return, whether you're in hedged or unhedged products. So this really exemplifies what happens when I, as a U.S. investor, would go out and purchase a German bond, for instance. Right? We see the two yield curves there. Okay, so you've got a German bond curve in negative territory going out 10 years. Never thought I'd be talking to people about this, but again, this is the environment we live in. So German bond curve versus the U.S. curve in red, where it was, I believe this was back in the end of the summer. But it's really more for illustrative purposes. When you factor in that hedge return, given hedging involves the interest rate dispersion between two countries, or when you factor in the expectation for changes in currency prices, I, as a U.S. investor in a risk-free U.S. Treasury security, would be indifferent between holding that Treasury security and holding a German bond, if you believe it's risk-free, security. At that exact instant, you make the purchase. Okay? Right after that point in time, that's when yield curves start to move in different directions, sometimes advantageous, sometimes disadvantageous. But that's where you get the diversification benefit of international bonds. But again, we're not, summation of all that is we are, U.S. investors would not be locking in a loss by investing in a international negative yielding security.
What's your outlook for commodities and real estate over the next 5 years versus?
So, we were talking earlier about real estate prices and inflation in real estate markets. We've seen quite a sharp rebound in a lot of markets, particularly those hardest hit by the housing crisis. Again, as Vanguard, we don't necessarily like to come out and say with definition where we see interest rate, or rather where we see real estate markets, commodities headed going forward. That said, we wouldn't expect outsized returns from real estate markets going forward, if that answers your question. In terms of relative to equities, we see them as a little bit riskier, given current fundamentals. On the commodity side, I talked about the slowdown in China. They're a big driver of commodity prices. We've been talking quite a bit about oil. Oil prices unlikely to go back to their $100 level for the foreseeable future, right? Even absent any sort of supply shock, we struggle to see commodities, oil in particular, really accelerating much beyond where they are. And then you talk about that slow growth outlook and the slowdown in China in particular. That doesn't tend to bode well for commodity prices. So without backing myself in the corner on the REITs and commodity question, I'd say that's where we stand.
Could we drill deeper into the oil discussion? It just feels like 1972 to me. We're about to get hit with the huge oil shocks, cost-push inflation, and stagnation. And I might be the only contrarian idiot thinking that, but what's to stop oil from going back up? What kind of collective action could occur from oil-producing nations to drive back supply in the glut and pop us over 100, 120?
I do hope that you're wrong.
Me too.
We've seen OPEC struggle to enforce even their own regulations on the member states. So we don't necessarily think that they're going to turn around one day. It's going to be a 1970 style oil embargo. But again, we don't say that that's totally out of the realm of possibility. The U.S., we're approaching energy independence, right? For better or worse, whichever side of the aisle you're on, we're moving that way, given fracking technology. Everybody talks about, well, fracking is not profitably at $45 a barrel. I guarantee you that oil companies knew that a long time ago and have been working day in and day out ever since to make it profitable at $45 a barrel or under, right? So, not to position myself as a futurist, but I tend to think that technology over time, it's going to step in, and especially when there's a desire for profits, right? For technological advancement in fields like oil, where you're going to drive down the cost of production, right? Oil sands production in Canada, we know that that's high, that's been getting cheaper. I read a story in the Atlantic, probably about a year ago at this point, where Japan has a machine that sucks oil up out of it removes it from the silt and the sediment from the bottom of the ocean floor, and they're able to produce oil that way. That costs about $200 a barrel right now, so that is not by any means effective or efficient, but that's not to say that it won't be over time, right? Again, we don't tend to take shorter term views, whether it's REITs, whether it's oil, whether it's equities, anything in general, really. So over longer periods of time, anything's possible, but I'd say in the near term, I wouldn't expect an oil price shock absent any sort of calculated effort on OPEC's part, and even that may not work out as they expect.
What aspect of your forecast do you have the least confidence in?
That's a great question. I would like to say it's currency. Right? I apologize for the dislocation on the slide. I'd like to say it's currency. Right? So our views right now, what we have here is a currency model that underlying it is trade dynamics. So what you have is an evolution of our trade with different countries, their basket of goods, et cetera, et cetera. And it provides a quote-unquote fair value for the U.S. dollar. That's what you see in the tan line there. The blue line is the actual valuation of the trade-weighted dollar. Right? You can see it does a reasonable job within those error bands of tracking where the dollar has headed. We don't use this for prediction. Right? Again, that's another area we don't get too deep into in terms of our forecasting is currencies. But U.S. dollar, it's been trending higher in terms of its historical norms, and also in terms of this fair value estimate. We would expect the dollar, it hasn't really moved much over the last 6 to 9 months. A lot of that appreciation was due to expectations for Fed creep, right, for the gradual removal of extraordinarily easy policies, and they've started that, right? So that's really been factored in. We wouldn't expect there to be too much more tightening, even if there were to be a rate rise or two in the next 12 months. But there's just so many factors that underlie, all of our forecasts, but so many other international factors that we have very, very little control over that underlie where valuations are for the dollar. So I would say, if I had to err on the side of caution, I would be more afraid of a stronger dollar in the current environment, despite what our models say. I'd have less conviction in that, and the idea that there could be something out there that drives the dollar higher and could negatively impact growth in the U.S. as a result.
I wasn't sure whether you answered this in your presentation, but I didn't hear it. Would you be willing to give a non-partisan opinion of the coming election?
Those are my favorite types.
Like I said, it's non-partisan, it's non-corporate, it's just what do you intelligently see, depending on who wins. So if you could give your opinion on both sides of them winning.
Certainly, and I joked earlier about the wall, and that's not to show my hand in terms of political affiliation. Vanguard, we stay as apolitical as possible. It's in the media, it's on everybody's front of mind, right? So, and I know that the election itself is front of everyone's mind. So, in our view, at the end of the day, this seems to go over well with clients for a number of reasons. Is that the U.S., we're a system of checks and balances. Right? In addition to the executive branch, we have the legislative and the judicial branch. Okay? There could be changes in all those over time. Right? right? But they work together such that in all likelihood, regardless of who takes office, whether it's Hillary Clinton, whether it's Donald Trump, you're unlikely to see their entire platform instituted, right? Even over the entirety of their tenure, right? In all likelihood, Hillary Clinton is calling for $275 million in infrastructure spending over 5 years. That's a bold goal, given the dislocations in Congress today. Is that really moving the dial that much?
The
Talking about
275 billion?
275 billion. Oh, did I say million? I apologize.
We might actually.
Not to- 275 billion. No, not to minimize that, but that's not really huge boots of GDP, right? I don't see how you increase efficiencies to a very, very large degree with 275 billion, particularly given the fact that the north of 75% of highways and railways are owned by state and local governments, or they're in the purview of state and local governments. So it seems like more of a posturing attempt. Donald Trump said he would double that. It didn't really explain how he would cover the cost of that. If things do go good, maybe he's able to do that with increased tax revenues. I don't know. But I don't think either party coming to office is really going to change the dial that much, given these underlying factors that we talked about today. So we try to, and we pull some stats every now and then where, so my boss is a economic historian, got his PhD because he created a industrial production time series that goes back to the pre-Revolutionary War. Right? So he's a big fan of, so he found a time series that goes back to, I believe it was the 1850s. Right? And he looked at asset market returns, equity market returns, that is, under each party, when each party held the presidency. So the 4 years they held the presidency, what those returns were that year. Democrat or Republican, both came out right at 10.5%. It did not matter for financial markets over those periods of time. Right? Not to say that there won't be some short-term volatility, there won't be some concern. Financial markets, economic fundamentals, they don't like uncertainty. And there's a great deal of uncertainty today. Not only here in the United States, this is symptomatic of the world. Right? We're seeing this come through Brexit. We're seeing this come through in the Italian referendums. It's pervasive. Right? It's symptomatic of the environment that we're in. A lot of that due to people not really acknowledging that it's going to be slow, it's going to be a tough slog through for the foreseeable future. And a lot of people, even when there were good times, were left behind. So I can relate with their concerns, but to say that one party coming to power versus another is going to have more impact than these defining fundamentals, in our view, I struggle to see that. So again, to try to bring things back to the asset allocation decisions, we try to bring the discussion, when it comes up, back to what's really important for your clients, right? The asset allocation decision, right? It's your risk profile, it's your investment goals. How do you put yourself in the best position to achieve that, right? So I like to share this slide, and I should end here given time, I apologize, but I like to share this slide because it helped to save my marriage. Right? So back in May of 2013, April of 2013, I apologize, my mother-in-law inherited some money, got her in touch with an advisor who put her into a balanced portfolio. And then in May of 2013, Ben Bernanke went before Congress, to your point, the impact of policymakers, and talked about the idea of potentially tapering at some point in the future. Just that they were thinking about it. And interest rates are up 100 basis points across the board over the next 3 months. I was fielding daily calls from my mother-in-law telling me I did not know what I was talking about. I did not deserve her daughter. Doesn't Vanguard know that when interest rates go up, bond prices go down? So I assured her we would convene an emergency meeting in an investment management group and I'd relay that information. So what we developed in part to help with those types of discussions is this graph. This graph, we think, really exemplifies the benefits of appropriate portfolio diversification. Right? Blue line, 100% stock portfolio. Tan line, 50-50 stock bond. Teal line is 30-70 stock bond. And you can see the ebbs and flows over time. Right? Some larger ebbs for the 100% stock portfolio. Right? But the intent of this is not to say that that's not appropriate for certain investors given their particular situation. That's my allocation. I'm 100% in stock. I'm comfortable with that, right? That's not to say I didn't feel a few stomach punches in that ride down to 55% losses in March 2009, when I did not take action. I stomached those losses, I stayed invested over the longer term, and it's paid off. Right? You've seen it's taken some time to come back, but it's paid off. Right? For investors, my mother-in-law, who may not be able to withstand those same types of losses or uncomfortable with those, maybe a 50-50 stock bond or a 30-70 stock bond is more appropriate for her. But the most important thing is making sure that your clients are comfortable, making sure that they stay invested. Because if I were to have gotten out at that bottom, like a lot of investors that we've spoken with have, it's very, very difficult to see a situation where I can get back to the same type of portfolio value that I would have had I stayed invested.
So what's the frequency of calls from your mother-in-law?
Now it's twice a week to tell me I've done something, done something wrong, don't understand something. So if nobody has any other questions, again, I thank you all for your time. It's been a great conversation.